Hey guys, welcome to Stock Talk with Nico Criticos. Today we're going to do some stock analysis for Tractor Supply, ticker TSCO. So this is a stock that I've had my eye on now for a while. I picked up like one or two shares a couple of weeks ago, but I'm not really building a big position yet because as you can see here, this stock has pretty much just keeps going up and up and up. There's not really too many big dips in this stock. It's up over 300% in the last 5 years. And it's even up 14% in the last year. So Tractor Supply is a retail company that focuses mainly on farm and ranch products. 50% of their revenue is coming from pet products and cattle products. And then they also sell other things like seasonal items and different, miscellaneous stuff. So this is a $27 billion company, and they do business in 49 out of the 50 states. And the first thing we're going to look at here is their revenue. So I changed my criteria list just a little bit here. All I did was instead of putting a yes or no check for each number here, we're going to give them a score out of 3 just so we can get a more detailed idea here. So first one on the list, revenue. What I'm looking for here is what I'm looking for most of these is going to be consistency, more so than if they do something or if they don't. It's more important that they can do something consistently. So revenue, we're looking at, you go all the way back to 1993. This company has pretty much grown revenue every single year. $0.2 billion in 93. Now we're at $14 billion. And so they're growing revenue on an average of about, if you look at the last 5 years, it's 14%. So a pretty respectable number. As for net income, it's a similar story. Very nice chart here, only they're actually growing net income even faster. In the last 5 years, it's been growing at roughly 20% per year. So both of those are pretty much perfect from my perspective. I'm going to get each of those a 3 out of 3. Then we get to the price to earnings. This is what has made me a little bit hesitant to make a big position yet. And that's because, as you can see here, the P ratio is, I would say the average is somewhere around a 20, with it being as high as 33 and as low as a 12. So right now we're sitting at 25, which is definitely above the mean or the median on this chart. So that's why I'm not making a big position yet. And because I just feel like I like to buy when there's a little bit of a dip or a little bit of a bad sentiment around the stock, and we haven't seen that yet. So that's what I'm looking for. So overall, I would give that a 1 out of 3. It's not in a bad spot. It's just a little bit higher than the average, and so that's why it's not really a healthy number to be buying at. Number 4, this one I'm not super, I don't know how sure I am on this one, because I was starting to think, are they innovative? Do they have a moat? It seems like their moat is the fact that they are, they say they are the biggest retailer in their space. So how I said, they're mainly working with, it's like a lot of farming products, it's pet products, it's stuff like that. So they also sell tractor parts and stuff like that. But see, it's a lot of like, for ranches and farmers, for tradesmen, stuff like that. So that's where I see that they have somewhat of a moat. And the other thing I like is that they try to make their locations in places where it's not as busy. So something like, Targets and Walmarts might be like in more busier populated areas. That's where Tractor Supply is a little bit different. And the other thing I like about Tractor Supply, we're going to get to this, is their margins. Their margins is higher than most retailers out there. Their margins are about 8% in the most recent year. And like Walmart, Costco, Target, those companies have like, 2, 3, 4% margins. So their margins are pretty strong. As for the growing industry, I put a 2 out of 3 because it depends how you look at it. Brick and mortar retail is a little bit different than e-commerce, but they're in both spaces. Either way, both industries are expected to grow. So not like it's a super fast growing industry, but it's still growing. So that gets a 2 out of 3. Return on invested capital. This is one of the most important ones on this list. And what we're looking at for this is, so this I gave a 3 out of 3 because even though it's not consistent, what I like about this is their numbers are so high. So if you look at their worst year on this list is 2000, 16%. Some companies never get to that high of a ROI. So that's phenomenal from that perspective. Then you look at how high they've gone. 2014, they achieved 41% on return on invested capital. Then in the last 3 or 4 years, you can see it's gone from 18, 19, 23, and then 23. So it is the last 4 years, it has been growing. So maybe we can get back up to these numbers of 30+%. But I mean, we're talking they're normally doing 20 to 30% for ROI numbers. And even though it's not super consistent, those numbers are so high, I'll give that a 3 out of 3. As for the equity, this is where the balance sheet might be the weakest part of this company. Not because they're managing the money super bad or anything, but just because of they don't have a lot of assets. They don't have a lot of assets. They don't have a lot of equity. And for the valuation to be $27 billion or whatever it is, $2 billion of equity is not a lot. So I like to take out the goodwill. That's the intangibles I like to take out. So we're going to subtract $250,000 from their equity. And let's say we get 1.7, 1.8 billion, right? That's what we're going to get about that number. So that's definitely not 15%. Well, so that's the next one. 15% is going to get a 0 out of 3. But as for it, the equity is growing, yes, 1.5 to 2 billion. Even if you take out the goodwill, it's still growing. So those are healthy enough numbers. I'll give that a 2 out of 3. Then we're going to take a look at the share count, and these are also very nice numbers here. 2006, it was 160 million shares. Today, it's only 111 million, and they consistently have lowered it by about 2% per year. That's perfect. It's very consistent. That's what I like to see. 3 out of 3. Then we get to the balance sheet. We're looking at, unfortunately, the ratio is not super good here. 8 billion in assets, 6 billion in liabilities. Not bad, but just not ideal. Not that good. So that gets a 1 out of 3. Profit margin over 10%. How I said, this gets a 1 out of 3, unfortunately. I could give that a higher score, honestly, because if you compare it to in the retail space, its competitors are much lower. But if you look at the margins, normally I'm looking for over 10% because it gives them more leverage it's less risky when they have higher margins. So, I mean, see, normally it's 6% to 8%, which not bad, but not good. I mean, it's good compared to Costco and Target, but it's not good in general terms. So that's like a 1 out of 3, maybe a 2 out of 3 if you want to be generous. Then we get to cash and receivables. This is where they don't have a lot here. They don't have a lot of buying power. They can't do much. They only have $200 million, and this is a $27 billion company. Last year they did about, off that $14 billion of revenue, they did about $1 billion in net income. So their cash is nowhere near that. That's a 0 out of 3. Healthy dividend. Main thing I'm looking for here is the payout ratio and if it's consistent. And normally you see a bunch of companies, they might pay a 4%, 5% dividend, but their payout ratios are going to be 70, 80%, if not 100 and something. This company's is only 38%. So if they really wanted, they could double this dividend and make it 3%, but I don't really want that. I don't like that. I'd rather have them have extra cash on hand and invest back into the company. So all I want to see is that their payout ratio is healthy and that this dividend, as you can see, it's been growing. It grows. Honestly, it looks like they're growing this dividend super fast. 2021, it was 50 cents and it went to $1 within 2 years. So they literally doubled their dividend. Even they're growing on an average of 27%. So the dividend is growing pretty fast. That's a 2 out of 3. I mean, I would give that a 3 out of 3 if the dividend yield was a little bit higher. I don't know. That dividend's growing really fast. Let's give that a 3 out of 3. Then we get to is over 20 years old. Yes, this company was founded in 1938. So all in all, we're looking at a 26 out of 42. Although they did miss a lot of points, it's still a company that I'm interested in buying. I am just going to wait till this PE ratio goes down. Now, if you look back at this chart, you don't have a lot of opportunities. You know, back in, let's say, May of last year, it had a small dip. But, I mean, this company doesn't seem to struggle too much. The stock chart keeps going up. So if we look at what analysts have them doing for EPS, they continue to grow. Revenue is growing at 6-7% a year. and EPS has gone from 9.7 to 10.5, and then expected to be 11.5 next year. So who knows? Maybe I'll have to buy into this company when the P ratio is higher than I would like. But ideally, I would want to be paying 20 times earnings, maybe 22 times earnings to build this out to a bigger position. But I'm mainly concerned with their consistency in their revenue, net income, and dividend. Their profit margins are better than most retailers, and their return on invested capital numbers are incredibly good, better than almost any company you're going to find out there. So that is my analysis for Tractor Supply. Let me know what you guys think. Comment down below if you are interested in buying this stock, or if you have a different stock you think is even better. Thank you for watching, and I will see you in the next video.